Did you sense a big shift yesterday from the chairman?
We did sense a shift. So I think particularly, obviously, at the end of last week, we saw this very much a risk-off tone with the new variant coming through, leading to, a huge amount of uncertainty back in the markets. And I think that led to, investors being obviously a little bit more cautious going into Chair Powell and his testimony. And I do think it did surprise the markets a little bit. I mean, we have been saying for some time that we think, the Fed really is in a position now where they can, accelerate the taper, where next year they can start to even, maybe raise rates maybe 2 or even 3 times, depending on how this new variant shapes out. But I think the market was caught a little bit off guard, just given the volatility that we've seen over the past few days with the negative news, around COVID. But I think in terms of the overall trajectory of the market, that's where it had been heading. I think it was just surprising given the context of the past few days.
QE has been very important for signalling to the broader economy and to financial markets as well. Marilyn, I just wonder what an accelerated QE taper would actually mean for this market. You, Rick Reed, and Bob Miller have made the point repeatedly over the last several months that a lot of this would be cancelled out by the taper at the Treasury. But if we accelerate things, does it have a bigger impact?
Well, I think on the margin it has a small impact, but the fact is that when they are still continuing to purchase assets, even as they wind down the amount that they hold, then they're still actually supporting and they're still providing very, very loose accommodative monetary policy. They're still continuing to buy assets. So even if they sort of accelerate this a little bit, we think that the level of accommodation at the moment is so high, and particularly I think yesterday we did start to hear a lot more caution from Chair Powell around just the very high levels of inflation that, are potentially becoming more persistent. And I think that's a factor that the Fed are now starting to really include in the forward guidance. And I think maybe they're just starting to shift the tone a little bit as we do go into, the FOMC meeting in a couple of weeks' time. I think it will be key for market participants to really see, the timing around the QE tapering, but also the timing around any potential rate increase as well. So I think given the high levels of inflation that we've talked about a lot, given the fact that the tone has shifted around that it could be a bit more persistent than so far we've been hearing from the Fed, I do think it's important.
One reason why perhaps Fed Chair Powell feels emboldened is because markets are letting him make these moves, to make these signals without getting disrupted too much. And I take a look at credit, nothing like the taper tantrum going back to 2013, but still, nonetheless, you are seeing money get withdrawn from the high-yield debt market and slowly see yields creep higher, the worst performance for that debt going back to September 2020. Is this a buying opportunity or a warning sign for what's to come?
I think potentially if you exclude the current uncertainty around the new COVID variant, it could be a buying opportunity when you think that, of course, as you expect to see, monetary policy normalize a little bit, and we have seen, obviously, the yield on treasuries increase. We've started to see spreads widen. We are seeing now better opportunities and better valuations in higher quality credit. So we have seen some investors sort of go up the credit quality spectrum. We have also, when you're talking about high yields, we're continuing to see investors as well, still continuing to prefer the loan market in many cases, given the floating rate structure. So I think, again, as the market is really starting to position itself for a little bit more normalization, although we're far from normal in this environment, and as we do see these ongoing levels of inflation that are persisting through into next year, then I do think we are seeing more dispersion also in the sectors that are seeing better prices, better valuations. So I think it's a buying opportunity, but I think also investors are being particularly cautious as we go into year end. Liquidity isn't particularly great at the moment, and as we do have this higher uncertainty, as we're discussing around the new COVID variant, around potentially measures to limit restrictions on movement, etc. So there's a lot of unknowns, but there could be potentially buying opportunities.